Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Friday, October 7th, 2022. And before we launch into this week's video, I would be remiss if I didn't stop and commemorate our 2-year anniversary. For it was 2 years ago that we launched out of our broker-dealer and into the independent channel. And in that time period, we have just about doubled in size. So for all of our clients who have been with us for so long, we say thank you. For the clients who have just recently joined us in the past couple of years, we say thank you to you as well. We continue to be humbled that so many of you are introducing us to other friends, family, colleagues, etc. That said, we do have capacity to continue to grow. We do have capacity to serve more clients. And as the practice continues to grow, we will simply add more team members so that we can continue to deliver best-in-class service. That said, if you're watching this and you're not a client, by all means, feel free to reach out to us. You can click the Contact Us button on our website, and we'll be in touch generally in less than 24 hours. And we'd be happy to see if we can't serve you. Again, we are located in Cary, North Carolina, as well as a satellite office in Southern Pines, North Carolina, but we serve clients all across the country, especially in today's digital age. That said, today we are going to talk a little bit about some economic data, as is our habit, and we're going to talk a little bit about the stock market rally that we have witnessed, and we're going to kind of keep that in perspective as well. So that said, let's take a look at our first chart. The first chart that we're going to take a look at today is actually something we posted yesterday over on our Facebook page. If you are on Facebook, we certainly hope you will join us there. Hit the like button once you've found us. Just search for Hicks & Associates Wealth Management and you should find us. It'll look like this. I'll put the link to our site in the comment section. But let's take a look at this post from yesterday. And the thing that we were trying to highlight was the fact that the month of October has started off in a fantastic fashion. The market has rallied about almost 5% in the first 3 trading days of this month. Now, the last time a month started in such a strong fashion was actually March of 2020. And you can see that I've highlighted that area on the chart where the month of March started with a 5% rally and then it fell 30% from there. So just because the market starts off with a rally, it doesn't mean that the bear market is over. It's far more complicated than that. So let's put this in perspective with the live version of this chart. This is what you're looking at is SPY. The ETF that mirrors the S&P 500 on the screen is 2019. You can see in 2020 started right in here with a minor correction. The market rallies to new highs in February, and then the market sells off into February. February was a very difficult month. This candle here, which you can see barely, is the last trading day of the month, and I'm trying to show it to you this way to keep things in perspective. This is a little bit of a nasty drop. Okay, well then March started and we see a rally. You can see the market rallies about 5%, and again, if you put that in perspective, hey, this decline is over, right? We had this big sell-off and the market rallied 5%, so we're in the clear, right? Well, again, now you know how the rest of the story goes. From this level, the stock market, the broad market as measured by the S&P 500, dropped another 29%. So just because the market has started the month of the month of October now in a strong fashion with a strong 3-day rally, that does not mean that this bear market is over. And this is today. This is Friday, October 7th. So we rallied the first trading day of October, another very strong day, Tuesday of October, and then the third day of trading. Yesterday was a little down, and today we gapped down much lower. Again, retesting this low. Now, again, this is to some extent good news, because if this holds, then we have a little bit more confidence when the market actually rallies. But again, if it rallies strong Monday and Tuesday, that doesn't necessarily mean that the bear market is over. Now, again, keep in mind, I'm not suggesting that I believe the stock market is going to drop another 30%. I have no idea. We are simply trying to keep things in perspective, that just because we have a rally, it doesn't mean the bear market is over. So we can't draw any conclusions from 1 or 2 or 3 days in the stock market. Switching gears and talking about a couple of economic data points that we see that continue to keep us concerned. on the screen now is the chart for total non-farm job openings. This data goes back to 2000, and what we're trying to highlight here is this correction. From all-time highs down to the current level, we are still very elevated. There's still a lot of job openings out there, but the steep correction in this data point suggests to us that business leaders are taking down job postings. They're saying, you know what, there's some economic concern ahead, and it would be wise for us to not to expand payroll any further so that we can weather the recession. So that has us a little bit concerned. Now we can take a look at the unemployment rate, and you can see that a current unemployment rate is about 3.7%. Now, one of the videos that we did a few weeks ago was discussing some research that some economists put out that suggests the Federal Reserve has not said this, but these researchers were suggesting that the unemployment rate may need to hit 7.5% in order for inflation to be under control. And again, you can see this has gone up from 3.5 to 3.7, so it has risen just a little bit. 3.7% unemployment rate is actually very good. Let's switch and talk about the North Carolina unemployment rate. Here in North Carolina, our unemployment rate is just at 3.5%. So overall, these levels are good. But again, to go back to what these researchers were suggesting, that unemployment here in the United States may have to get as high as 7.5% in order for inflation to get under control. And just note what kind of a rise we would have to see if that were indeed true. So the last chart of the day comes from Twitter. Charlie Bilello, I think is how I would say his name. Charlie, if you happen to see this and I've mispronounced your name, please forgive me, but this is a great chart and I thought it worthy of sharing. And so what he is highlighting here is the U.S. median housing payment as a percentage of median income. A fantastic chart, and it is simply highlighting how dramatically payments have risen as a percentage of people's income. As interest rates continue to rise, and we do expect them to continue to rise, this chart allegedly would get worse. But what we would expect to happen would be the housing market would continue to cool, and that is not a good sign for the economy, as the housing sector does drive a large portion of the economy. We'll wrap it up here for the day, but I would be remiss if I didn't wish my son a happy birthday. He will be turning 9 years old tomorrow. He is a true blessing to all of us. And right now, my fantastic wife is putting the finishing touches on the cake that she's making for him. Should be epic as usual. She makes some fantastic cakes. Perhaps next week I'll show you a quick video of one of her concoctions. She's amazing at it. Anyway, again, thanks for watching.